Over the past few months, the nation's financial markets have been gripped by a dizzying mix of speculative frenzies and sobering realities. From Bitcoin's gravity-defying ascent to the persistence of stubbornly high inflation, the economic landscape is a study in contrasts. Let's start with the crypto craze that has seized Wall Street. In January, the debut of 11 new Bitcoin exchange-traded funds was met with a tidal wave of enthusiasm. $850 million came pouring in, propelling the cryptocurrency to dizzying new heights near $73,000. For the digital gold bug set, it seemed the floodgates had burst open. But this week, that torrent of capital reversed course just as quickly. $850 million drained out, sending Bitcoin tumbling back below $61,000. People have looked at how much the price has fallen and they've decided to hold off. Nobody wants to catch a falling knife, remarked James Butterfill of CoinShares in an admirable display of level-headedness. The ETF mania is a microcosm of the larger Bitcoin saga, periods of delirious buying punctuated by bouts of cold feet. While BlackRock hoovered up $576 million in inflows, products from Fidelity and others saw barely a trickle. Grayscale, meanwhile, can't seem to shake the exodus, its higher fees driving investors to flee. As Elon Solid of Merex put it, we're approaching a dead zone where the initial frenzy has come in already. One wonders if this lifecycle mania, disillusionment, mania anew, will remain the norm for the foreseeable future. While the crypto circus captivates some, others are focused on the relentless march of inflation vexing the Federal Reserve. Despite the central bank's yeoman's efforts to tame searing price increases, progress remains elusive. This week's personal consumption expenditures data for February is expected to show core inflation, the Fed's lodestar, still raging at 2.8% annually. A modest uptick from January's blistering pace, but hardly a triumph for the Eccles building. The forces propelling this inflationary overshoot are multifarious: supply shocks, excess stimulus, labor shortages. But the human cost is plain. For the score of Americans whose wages are failing to keep pace, these rising costs are more than just economic abstraction. They sting in a visceral way at the grocery, till, and the gas pump. Some at the Fed argue their catchphrase of higher for longer interest rates will allay these pressures. Perhaps in time. But as painfully high CPI figures attest, the iterative process of cooling demand hasn't gotten the job done yet. The Phillips curve has gone wobbly. Finally, let's turn to the mysteries of the gold market, where the barbarous relic has reclaimed some of its ancient splendor. In a blistering rally, defying obvious explanation, gold prices crested $2,200 an ounce this month, before settling somewhat. To some, it's a simple flight to the oldest of safe havens amid geopolitical conflagrations in Ukraine and the Middle East. Others cite the Fed's dovish pivot and expectations of rate cuts as catalyzing inflows. Still others point to voracious central bank and retail buying, the latter animated by a dingy cousin of the crypto FOMO that is powering Bitcoin. Analysts like ING's Ava Manthi argue this rally has further to go, citing an amalgam of these drivers: conflict jitters, rate cut odds, persistently strong demand. But she concedes the biggest risk lies in upended Fed expectations, a hawkish surprise that would diminish gold's luster. Indeed, one senses a cloud of uncertainty hanging over all these market narratives. In Bitcoin's case, what lies past the initial frenzy? For inflation, what transmission channels still need fortifying for policy to gain traction? And for gold, is this anything more than a collisional conflux of jittery narratives? In times like these, the path forward often lies in embracing the Socratic certainty of "I know that I know nothing," maybe the wisest posture amid the clashing market currents swirling about us. For every seeming coalescence of logic in these fevered trading movements, disruptive uncertainties and fearful bouts of irrationality lurk. Take the Bitcoin saga that has unfolded with such whiplash-inducing velocity. The frenzied flows into the new ETFs bespoke a unanimous belief in crypto's unlimited upside. Yet the outflows that followed with equal velocity highlighted the market's caprice just as vividly. What are we to make of this emotional ebb and flow? Is it the initial frenzy of pent-up demand giving way to a dead zone of disillusionment as Solid predicts, or merely the inherent volatility of an immature asset class where herd behavior reigns? The eternal crypto-optimists will argue this is simply the bottoming process playing out, the indispensable preamble to Bitcoin's mythical status as a universal reserve currency. Butterfill's catching a falling knife allegory captures this mindset: the dips are to be embraced, not feared, and yet, each dizzying plunge tests the resolve of even the most ardent hodlers. At what point does the market's mantra of buy the dip curdle into the fatalistic recognition of a protracted downtrend? No one can know for sure. This existential uncertainty is echoed in the great inflation puzzle that continues to buffet the Fed's grandest efforts at demand restraint. For every sliver of progress and semblance of subsiding price pressures, ominous signals emerge to spook the market anew about entrenched inflation forces stubbornly taking root. The February PCE data will offer another such inflection point, a fraught milestone that could easily renew scorching wage demands and unsettle the Fed's gradual policy glide path. Mix in the latest geopolitical flare-ups and commodity shocks, and the quagmire only deepens. The path to the elusive 2% sweet spot seems surrounded by disruptive forces beyond the Fed's control. Hence, the run to gold as the quintessential crisis hedge against these swirling uncertainties. But even here, ambiguity reigns over the underlying drivers. Is it conflictual anxiety and fear over a new Cold War with Russia and China catalyzing the flows? Or is it the more banal, if no less consequential, dynamic of investors losing faith in fiat defenselessness against spiraling prices? Or perhaps a more rational reappraisal of gold's unique status as the monetary commodity sans counterparty risk after the seizing of Russian reserves? A renaissance of the barbarous relic's ancient prestige in a fragmenting geopolitical order? Whatever the answer, it is striking that even with gold's rally, we remain well below its inflation-adjusted record highs from 1980. A reminder that for all its fear-derived appeal, its purchasing power has still been severely eroded over time. Amidst these clashing narratives, dueling perspectives, and market ironies, the temptation is to hunker down and await clarity. To borrow the approved lexicon, we could await the inevitable return to normal, presumably lurking around the corner. And yet, is that not the favored delusion of every era? The assumption that the upheaval at hand is but a fleeting dislocation from an imagined steady state? Perhaps the true wisdom is to embrace the perpetual condition of imbalance and uncertainty as the norm, not the exception.